How do you pull in like $3.8 billion in exactly 90 days, but somehow manage to walk away with just a single penny of profit per share?
Well, it requires a very specific, almost perfect storm of macroeconomic headwinds. You have to be squeezed on every conceivable front,
Right.
like supply chain, labor costs, and plunging consumer demand all at the exact same time.
Yeah, it's wild. Welcome to the deep dive, everyone. Today we're unpacking the Q1 2026 financial results from CNH Industrial. And if you aren't familiar with that corporate name, you definitely know the heavy metal they build.
Oh, absolutely. Case IH, New Holland.
Exactly. They are an absolute global titan in agricultural and construction equipment. We're talking about the actual machinery that forms the physical backbone of the global food and infrastructure supply chains.
Yeah, the real heavy lifters.
Right. And the source material we have today, specifically their official earnings presentation and the press release, it paints a pretty intense picture for you to look at. The CEO literally called this the lowest period of the current agriculture cycle.
Which is saying something in that industry.
So our mission today is to decode how a multinational manufacturing giant actually survives a trough this deep. We are looking at this delicate balance between brutal global market forces and micro-level factory efficiencies.
It really serves as a phenomenal case study in corporate control.
Yeah.
You know, when the global economy turns against your primary product line, you're forced to figure out what levers you can still pull internally.
Right, just to keep the business solvent. Okay, let's unpack this because the highest level numbers present an immediate glaring paradox.
They really do.
Looking at their consolidated revenues for the first quarter of 2026, the top line is completely flat year over year. They brought in $3.8 billion.
Which is virtually identical to Q1 of 2025.
Yeah. And to a casual observer, maintaining your revenue in a down market, I mean, that sounds like a massive win, right?
Well, yeah, in a vacuum, flat revenue during a cycle trough is commendable. But revenue is just the money coming through the front door. The story completely flips when you look at what actually managed to make it out the back door as profit.
Because the bottom line absolutely plummeted. Net income dropped 92%.
92.
They went from $132 million a year ago down to just $10 million this quarter. As I mentioned, their diluted earnings per share was $0.01.
1 penny.
1 penny. And if you look at their free cash flow for industrial activities, they saw a total absorption of $589 million.
Yeah, that is a severe cash burn for a single quarter.
Right.
I mean, $500 million just
Gone.
right.
It's like, imagine keeping your job during a recession and your salary stays exactly the same. You feel a false sense of security.
Sure.
But then your rent, your groceries, and your utilities all triple in the span of 3 months. Your top line hasn't changed, but your savings account is getting completely wiped out just to keep the lights on.
That's a really good way to look at it.
So where is all of CNH's cash vanishing to if the revenue is completely flat?
To understand the margin collapse, we have to look at operating leverage. It's a confluence of input pressures eroding that $3.8 billion before it can ever become net income.
Okay. What kind of pressures?
Well, the sources highlight several overarching headwinds. Most immediately, they're dealing with intense labor inflation and higher selling, general, and administrative expenses, or SG&A.
Which means the baseline cost of maintaining their workforce and their corporate structure has fundamentally shifted upward.
Exactly. They specifically call out higher variable compensation alongside that labor inflation. But, and this is important, they're also choosing to spend more in certain areas.
Wait, really? They're spending more while losing cash?
Yeah, R&D expenses actually jumped from 6.3% of sales up to 7.9%.
Oh, wow.
They are actively choosing to spend more capital developing future technology, even while their current profit margins are getting squeezed.
So they're playing the long game there.
Right. And you add in a remarkably tough macroeconomic market in South America, and you have this massive sponge soaking up all the cash flow.
Which brings us to their core business, agriculture. To understand those plunging profits, we have to look at the tractors and the combine harvesters.
Bread and butter?
Yeah. Agriculture net sales were actually up 1%, sitting at $2.6 billion. But the adjusted EBIT, the earnings before interest and taxes, dropped 81%, down to just $27 million.
That's a steep drop.
And the macro environment in North America, which is historically their most stable bedrock, it just looks incredibly bleak.
Yeah, the drop in demand across specific equipment categories is the critical data point here.
Yeah, let's look at those. The sources show demand for small tractors. Anything under 140 horsepower is down 7%. Combine harvester demand is down 6%.
hmm
But the massive red flag is the large tractors. Over 140 horsepower, demand for those crashed by 27%.
27%. That's massive. And you have to remember, those large tractors represent massive capital investments for a farming operation.
Right.
We are talking about machines that can cost $500,000 or more. When a farmer holds off on buying a high-horsepower tractor, it tells you everything you need to know about the current agricultural economy.
Because they just don't have the cash.
Exactly. They're looking at low commodity prices for their crops, high input costs for fertilizer and fuel, and they're making the calculated decision to just patch up their old equipment and make it last another season.
So what does this all mean for CNH? Because, if I'm running a dealership and I see consumer demand for my most profitable, high-margin products suddenly drop by 27%,
Right.
my holding costs are rising every single day that machine sits on the lot. The standard business instinct is to discount.
Of course it is.
I'd want to slash prices, put a massive promotion out there, and just move the metal to keep the cash flowing.
Yep.
But according to the presentation, CNH is intentionally keeping factory production low. Why aren't they discounting to stimulate the market?
Well, what's fascinating here is their absolute commitment to pricing discipline over short-term volume. CNH is executing a strict channel inventory strategy. You have to remember how this business works. CNH doesn't sell directly to the farmer.
Right. They sell to independent dealers.
Exactly. If CNH forces production and floods those dealers with large tractors that nobody's buying, those local dealers are left holding the bag.
Oh, I see.
They end up paying massive floor plan interest cost on inventory that won't move.
Which would force the dealers to, panic sell at rock bottom prices just to clear their lots.
And that is the exact scenario CNH is trying to prevent. They are accepting the pain of lower factory sales volumes today to protect their pricing power and their product cost performance.
That makes sense.
Yeah, if you flood the market and heavily discount a premium agricultural machine, you don't just lose margin today, you destroy the long-term value of the brand.
Right. Because when the market eventually recovers and crop prices rise, farmers are going to expect those same heavy discounts.
Exactly.
Yeah.
By choking off supply at the factory level and holding channel inventory steady, CNH ensures that their pricing integrity remains completely intact for the next upcycle.
Wow. That takes a lot of corporate nerve. I mean, you are watching your net income drop 92%. You're burning $500 million in cash, but you refuse to artificially stimulate demand because it ruins the brand's long-term math.
It is the definition of taking a long-term view in the middle of a short-term crisis.
Here's where it gets really interesting, but also, where I have a hard time buying the corporate narrative.
Okay, let's hear it.
If they are intentionally slowing down the assembly lines, they have to find cash somewhere else. The sources detail a project-based approach to drive manufacturing plant efficiencies. They outline over 1,300 efficiency projects slated for 2025, and they executed over 300 in the first quarter of 2026 alone.
Yeah, it is a relentless optimization of the things they actually have physical control over.
Right, and the presentation gives a highly specific example. At their Fargo plant, they installed a new fiber laser. This single laser reduced sheet steel cutting time by 52%. It reduced the consumables they use, it minimized secondary operations, meaning workers didn't have to spend as much time grinding or cleaning up the cuts afterward, and it improved overall quality.
That's a solid upgrade.
It's a great story. It's like a Formula One team realizing they can't make the engine any bigger because the rulebook forbids it.
Right.
So instead, they figure out how to shave ½ an ounce off the driver's steering wheel to gain a millisecond per lap. But let me push back here.
Go for it.
They lost $589 million in cash. Does shaving a few seconds off a sheet of steel in North Dakota actually move the needle? Or is this just corporate PR to distract investors from the massive losses?
It's a fair challenge, but you have to look at the operational gearing of a manufacturer at this scale.
Okay.
This isn't just about saving a few dollars on steel in one facility. This micro-level optimization is a foundational pillar of their Path to 2030 framework. CNH is heavily focused on what they call iron plus tech integration.
So the physical machinery merging with the software and precision agriculture.
Yes, exactly. By implementing these hundreds of micro-efficiencies right now, during the trough of the market, they're doing two vital things.
Which are?
First, They project delivering $45 million in agriculture manufacturing efficiency savings for 2025.
Okay, so that is real cash that helps offset the current bleeding.
Right. But more importantly, they are fundamentally lowering their baseline cost to build a machine.
Ah, I see the leverage there. It's about preparing for the rebound.
Exactly. If we connect this to the bigger picture, think about what happens when the market recovers,
Demand goes back up.
right? When crop prices rise, farmer demand returns, and CNH scales production volume back up, those Fargo laser efficiencies don't go away.
They're permanent.
They remain permanently baked into the manufacturing process. Because they lowered the cost to build the tractor during the downtime, their profit margin per unit will be significantly wider during the next peak than it was during the last one.
That's smart.
In financial terms, they are doing the hard work now to expand mid-cycle margins.
But building the machine efficiently in Fargo is only half the battle.
Yeah.
Once that machine actually rolls off the assembly line, it runs headfirst into the realities of global borders and trade policy.
Unfortunately, yes.
Which brings us to CNH's other major segment, construction.
Yeah, construction is a smaller piece of the overall revenue pie than agriculture, but its supply chain is highly sensitive to geopolitical shifts.
And the numbers for construction in Q1 2026 are rough. Net sales dropped 3% to $574 million.
Yeah.
But the real issue is profitability. The segment actually lost money, posting an adjusted EBIT of negative $28 million.
Yeah.
That is a negative 4.9% profit margin, and the sources are very explicit about the cause. They place the blame squarely on tariffs.
They do. The earnings documentation specifically points to rapid, unforeseen changes in tariff and transportation costs.
Right.
They highlight the ongoing impacts of Section 122 versus IEPA, which is the International Emergency Economic Powers Act, often used for global sanctions.
Oh.
And Section 232 impacts, which generally relate to tariffs on steel, aluminum, and imports deemed critical to national security.
And just a quick note for you listening, we're not taking any political stance here, and neither is CNH in the reporting. We're just looking impartially at what the source material states about the financial impacts.
Exactly. They are strictly navigating the cold, hard accounting math of how rapid tariff deployment functions in a manufacturing network.
Right. And it's crucial to note that these Section 232 tariffs aren't just impacting whole finished machines moving across borders. They are heavily impacting raw component parts.
Yes, the parts themselves.
So how does this actually function on the balance sheet? Like, if a tariff suddenly hits a hydraulic valve or steel bracket coming in from overseas, how does that disrupt the bottom line before the backhoe is even fully built or sold?
To understand that, we have to look at the mechanics of a just-in-time global supply chain.
Okay.
A manufacturer like CNH sources component parts from multiple countries based on incredibly precise long-term cost models.
Because they need to know exactly what a machine costs to build.
Right. And they also have agreements with their dealers regarding the final market price of a construction machine. So if a sudden tariff is enacted on a specific category of component parts, the cost to import that hydraulic valve immediately spikes.
Oh, I see.
But the selling price of the final backhoe loader was likely locked in months ago to remain competitive in the market.
So there is a massive mismatch. CNH has to absorb that sudden component cost increase directly into their manufacturing overhead.
Exactly. They cannot easily pass that 15 or 20% cost spike onto the consumer without destroying demand, so they just have to eat it.
Wow.
It immediately degrades the profit margin of that specific machine as it moves down the assembly line.
Yeah.
In their financial breakdown, they note that product cost was the single biggest negative driver for the construction segment's profitability.
Far outweighing the actual drop in sales volume.
By a lot. Yeah.
They are actively pursuing what they call tariff cost offset opportunities, which I assume means trying to find new suppliers in non-tariffed regions.
Usually, yes.
But rerouting a global supply chain is a massive logistical nightmare that takes time. It leaves short-term profitability completely exposed.
It perfectly illustrates how macro geopolitics can instantly wipe out micro-level factory efficiencies.
So we've looked at the factory floor, and we've navigated the international trade borders. Now we have to look at the final step of the life cycle.
The customer.
Right. How does the end user, the farmer in the field, or the construction company on the site actually pay for this $500,000 equipment? This brings us to a really fascinating part of CNH's business structure, their financial services arm.
The financial services segment acts as an incredibly accurate, real-time health monitor for the broader global agricultural economy.
Because they aren't just building the tractors, they are actively loaning the money to the customers to buy them.
Exactly.
The financial services segment currently manages a staggering $28 billion portfolio. Just think about the scale of that for a second. Imagine you're running a heavy manufacturing business, but on the side, you're essentially operating a bank the size of a large regional credit union, carrying $28 billion in active loans.
It highlights a structural reality of the industry. You cannot separate the manufacturer's balance sheet from the financial health of the customer.
They're totally linked.
They are deeply inherently intertwined. If the farmer fails, the manufacturer takes the hit directly.
And right now, that health monitor is flashing warning lights. Net income for the financial services segment fell 18% to $74 million.
Yeah.
The crucial metric to watch here is delinquencies. The percentage of their loan book that is greater than 30 days past due crept up to 3.5%.
This raises an important question about liquidity and risk management. Why are those specific loans falling behind?
Well, the sources are highly specific about the geography of the problem. It is primarily driven by economic and environmental factors hitting farmers in South America.
Specifically Brazil.
Yes, specifically Brazil. The report cites a brutal combination of low commodity prices and high input costs in that specific region.
This is the butterfly effect of global agriculture in action.
Right.
A farm equipment loan isn't like a standard car loan. It is tied to a depreciating asset that relies entirely on the volatility of global crop markets.
So a bad weather season in Brazil directly hits the earnings of a global manufacturer.
Exactly. If the weather in Brazil is poor, or if a bumper crop in the United States suddenly drives down global soybean prices, the Brazilian farmer's profit margin vanishes overnight.
And they suddenly struggle to make the payment on their combine harvester.
Right, because CNH financed that machinery. That localized struggle in a Brazilian soybean field ripples directly into the quarterly earnings of a global equipment manufacturer.
Wow. And I want to make sure I understand the mechanics of this. When those delinquencies tick up to 3.5%, it forces CNH to increase their risk reserves. How does that actually trap capital?
Well, when a certain percentage of your portfolio goes past due, strict accounting rules dictate that you must increase your allowance for credit losses.
Okay.
You literally have to take liquid cash and park it in a reserve account to cover the loans you suspect might default.
Which means that cash is completely frozen.
Yep.
You can't use it to fund an R&D, you can't use it to buy new lasers for the Fargo plant, and you certainly can't return it to shareholders. It starves the operational side of the business of necessary liquidity.
It perfectly illustrates why the leadership team refers to this as the bottom of the cycle.
Yeah.
You have demand completely dropping off in North America, tariffs aggressively eroding construction margins globally, and South American farmers struggling to make loan payments, which forces you to freeze your own cash.
The headwinds are quite literally coming from every point on the compass.
Every single one.
Which brings all these complex threads together as we look at the outlook for the rest of 2026. Falling demand, supply chain tariffs, factory optimizations, and trapped capital.
It's a lot to manage.
How does a massive legacy corporation actually react to a 92% drop in net income amidst all these pressures?
With a rather surprising level of confidence.
Yeah. That was genuinely the most unexpected part of the source material. Despite everything we've just unpacked, the absorption of almost $600 million in cash, CNH firmly reaffirmed their full year 2026 guidance.
They did.
They are not lowering expectations. They still project generating a positive free cash flow of between $150 million and $350 million for the full year.
Furthermore, they are maintaining their commitment to a strong investment-grade credit rating.
Right.
And, critically for the market, they are still committing to returning cash to shareholders through their dividend program and ongoing share buybacks.
You're essentially looking at the data and saying, yes, the storm is terrible and it's hitting us from every angle, but our ship is built to survive it and we are not altering our course.
It all comes back to that strict channel inventory discipline and those micro-level factory floor efficiencies.
Yeah.
They fundamentally believe they have trimmed enough fat, protected their long-term pricing power, and lowered their baseline manufacturing costs enough that they can still generate hundreds of millions in cash even at the absolute grinding bottom of the market cycle.
It is an incredible corporate balancing act, but it leaves me with a final thought, something for you listening to mull over as you think about the future of this industry.
Okay.
We've just spent a lot of time exploring the defensive mechanics of how a massive legacy iron manufacturer survives a deep market trough. They delay production, they find efficiencies in steel cutting, they manage localized loan risks.
The nuts and bolts of survival.
Right. But as the entire world rapidly pushes toward sustainable agriculture, precision technology, and fully autonomous farming, what happens when the next peak cycle inevitably arrives?
That is the technological horizon line they are racing toward, heavily funding that R&D even while margins are tight.
Will the farmers who manage to survive this tough economic period by patching up their old equipment suddenly demand not just a replacement tractor, but an entirely AI-driven, tech-heavy, automated fleet?
It's very likely.
And if so, how does a massive company that has spent over a century mastering the production of heavy iron pivot its entire global supply chain overnight to meet a sudden boom in demand for what are essentially giant rolling robots?
That's the million-dollar question.
Because as we talked about at the very beginning, a 400 horsepower combine harvester looks like a completely unstoppable physical force from the outside.
Oh, yeah.
But navigating the future of the global economy isn't just about physical momentum anymore. It's about how quickly you can rewrite the code that actually drives the engine.
A phenomenal and complex challenge for the years ahead.
Thanks for joining us on this deep dive. We'll catch you next time.